Hello and welcome to our Moments with our Investment Gurus webinar. Just some housekeeping. We applied for Continuous Professional Development or CPD points. It's important to please watch the full session and add your ID number to the CPD section so we can verify your attendance. You may also view this event on this platform at any time until the end of August and receive your CPD points. The CPD certificates will be mailed to you during September 2023. Please also feel free to ask questions in the Q&A section, and our speakers will either answer them live or get back to you after the event. You will also find more information about our speakers under the Speaker tab on the top menu bar, or if you scroll down. You can also download the PDF presentations. I do hope that you enjoy this session and find it valuable. First up is Theo Terblanche, our Executive Head of Investment Management, who will do a brief introduction. Welcome, Theo. The stage is yours.
Thank you, Mike. Hello, everyone. Thank you for joining us again for another installment of our Moments with our Investment Gurus webinar. Preparing for these webinars remain a highlight in our team's calendar, and I hope you will enjoy the content today as much as we did preparing it. While global markets have recovered somewhat over the last couple of months, with inflation stabilizing and interest rate cycles nearing their peaks, the local economy seems to stumble from one self-inflicted crisis to the next. This, together with the uncertainty around the likelihood of a recession in the US, resulted in a lot of volatility in general. How do you make sense of this all? And what is the likely impact on your and your clients' portfolios? We have a full agenda today, hosted by a lineup of specialists who will hopefully help you to get some answers to some of these questions. Our economist, Sanisha Pakrasamy, will start off this morning by taking a critical look at the state of the South African economy. Is there still room for us to solve some of these challenges, or is it already too late? She will also share her insights into which of these challenges should be prioritized for maximum effect. Next up, Herman van Papendorp, Head of Investment Research and Asset Allocation, will discuss his views around the likelihood of a recession in the US and the impact this will have on the interest rate cycle. He will also share views on the impact this has on portfolio positioning. Mike Atsitz, CIO at Momentum Investments, and Colin Graham, Head of Multi-Asset Strategies and Co-Head of Sustainable Multi-Asset Solutions at Robeco, will follow Herman, providing us with a global perspective on risks and opportunities. Mike and Colin will be followed by Karabu Sima, a portfolio manager in our fixed income team, who will be discussing the credit market in South Africa and where to find value. Lastly, Lofty Botha, Head of Systematic Strategies, will provide us with an overview of systematic strategies and how these portfolios perform over time. He will also discuss how different factors have converged over the last while and the impact of this on portfolios. As you will see, our agenda will provide you with deep insights from our team of experts. I trust you will enjoy this session with us, and please feel free to reach out afterwards with any questions you may have. Thank you.
Thanks for setting the scene, Theo. Next is our economist Sanisha Pakrasamy, who will delve into why we can be optimistic that there's sufficient time for us to turn the South African economy around. Thank you for joining us today, Sanisha. Please take it away.
Thanks, Mike. Hello, everyone. Back in 1967, James Meade, a renowned Nobel Prize laureate in economics, made a well-known prediction that painted a bleak future for Mauritius. He highlighted the nation's susceptibility to weather and price fluctuations, as well as its limited employment prospects beyond the sugar industry. But in a remarkable turn of events, this petite island nation defied all expectations, transcending its status as a struggling sugar-driven economy. Instead, it emerged as a shining example, boasting the second highest per capita income among African countries and earning the top rank in the World Bank's Doing Business survey for all sub-Saharan nations in 2020. Despite its vulnerability to external shocks as a small-scale economy, Mauritius has successfully charted a robust developmental path focused on sustained growth. the country's achievements can be attributed to a combination of factors, including political stability, a robust institutional framework, minimal corruption levels, and a favorable regulatory environment. Additionally, Mauritius' commitment to open trade policies has played a pivotal role in maintaining its economic momentum. Governed by a parliamentary democracy, the nation showcases an efficient administrative apparatus that demonstrates both technical expertise and adaptability in the face of ever-changing global economic conditions. Although there are no guarantees for its future prosperity, Mauritius has demonstrated its capacity to navigate various economic shocks successfully. Throughout its history, the nation has showcased adaptability, innovation, and a keen ability to anticipate global shifts. The amalgamation of effective leadership, consensus building, prudent macroeconomic management, and strategic policies for the private sector positions Mauritius favorably for the times ahead. Is it possible for South Africa to achieve the same transformation as Mauritius? I believe the answer is definitely yes. However, this outcome hinges on a proactive stance of our authorities, who must not remain passive spectators and should rather swiftly initiate the right strategies to grasp these so-called low-hanging fruits that lie within reach. The phrase low-hanging fruits is used to refer to quick wins that are easy to implement, in this case by government. It is knowing how best to use available resources and implement interventions that are most feasible, technically, politically, and administratively. These are actions that will likely have the greatest positive impact on growth and employment. The country has been overwhelmed with bad news over the past few months, and the mood of the country has remained sour. Business confidence and consumer sentiment are tracking nearly 15 and 20 points respectively below their long-term averages. In its Article 4 mission to South Africa, the International Monetary Fund remarked that South Africa's economic and social challenges are mounting, risking stagnation amid an unprecedented energy crisis, increasingly binding infrastructure constraints, logistic bottlenecks, a less favorable external environment, and climate shocks. The IMF noted that employment remains below pre-pandemic levels. Notably, unemployment is close to record highs on the back of already elevated poverty and inequality. In addition, the economy remains exposed to external shocks and capital flow volatility in the context of tighter global financial conditions and volatile commodity prices related to Russia's war in Ukraine. The IMF further highlighted long-standing rigidities in South Africa's product and labor markets, while warning that governance and corruption vulnerabilities have weighed on growth and employment prospects, ultimately threatening the future of social cohesion. Expressing optimism about South Africa against this bleak background might seem out of place, given flat growth in per capita incomes since the global financial crisis of 2008, job insecurity, malfunctioning state-owned enterprises, and widespread corruption. The Economic Reconstruction and Recovery Plan has been a key tenet of President Cyril Ramaphosa's agenda since he succeeded Jacob Zuma as the country's leader in 2018. But deep divisions within the ruling party and his own cabinet have hindered progress, resulting in a slow-paced implementation of political and economic reforms. The economy was already in a fragile state when it got hit by events like the COVID-19 pandemic and the Russian incursion of Ukraine. On top of that, sluggish investment prolonged economic stagnation. There were also domestic factors like restrictive macroeconomic policies and budget cuts that have contributed to sluggish economic activity. To make matters worse, global supply chain disruptions caused prices of food and energy to skyrocket worldwide, including South Africa. This made the cost of living crisis even more challenging for many households. The bottom 30% of spenders in South Africa have experienced an average inflation rate of 10% in the past 6 months. And as if that wasn't enough, the subsequent tightening of monetary policy added an extra pinch to struggling consumers. South Africa's reputational damage also took a hit earlier in the year when the Financial Action Task Force greylisted the country in February. A souring of international relations following allegations that South Africa had supplied Russia with ammunition via a Russian ship that docked in the Cape have further threatened South Africa's economic and political ties with the Western economies. As such, very few are doubting that this will be a very difficult year. But what makes me more optimistic on economic activity in the medium term is tangible progress on priority reforms which have been identified for their potential impact on economic growth and job creation. To fast-track the delivery of economic reforms which are at the core of the Economic Reconstruction and Recovery Plan, including those that have been delayed or blocked before, a joint initiative between the Presidency and National Treasury was set up to monitor progress and actively support the implementation of these reforms. This is done primarily through addressing obstacles that hinder execution on policy commitments. Government has noted that Operation Vulindlela differs from previous efforts in that it has provided a dedicated team with skills and capacity to mobilize technical support to get these reforms over the line, but using a hands-on approach. While Operation Vulindlela is not a new plan, it aims to ensure the effective implementation of plans that already exist without additional fiscal funding by removing policy and regulatory barriers to private investment. Since the launch of Operation Vulindlela in October 2020, government has taken significant steps towards implementing structural reforms aimed at stabilizing South Africa's energy supply, establishing a competitive logistics network, reducing costs, and enhancing the quality of digital communications. Other areas included as well reforming the visa system to attract the necessary skills for business growth, as well as providing a seamless experience for visiting tourists. This narrow list of focused priorities have been identified as the main economic levers to achieve the greatest positive impact on growth and employment. These reforms are meant to reduce the cost of doing business and lower the cost of living for ordinary citizens, which will make South Africa more globally competitive and increase the rate of inward investment. Let us take a look at each of these priority areas. Electricity reforms. In the electricity sector, the desired outcome of the reforms is to stabilize electricity supply. Reforms under Operation Vulindlela have been aimed at addressing the shortfall in electricity, the lack of competition in electricity generation, the inability of government to fund investment in additional generation capacity, and to arrest the deteriorating quality of municipal electricity distribution services. Reforms are currently underway to restructure Eskom by unbundling the utility into generation, transmission, and distribution. This, together with the Electricity Regulation Amendment Bill, which was approved by Cabinet in March this year, will allow for greater competition in electricity generation by increasing the role of independent power producers in the private sector. Not only does this instill a more level playing field for all power generations to operate on, these reforms will also achieve greater energy security. Moreover, the amendment to Schedule 2 of the Electricity Regulation Act to remove the licensing requirement for generation projects of any size has unleashed more than 100 projects or 10,000 megawatts, which are now at various stages of development. This accounts for more than 200 billion of private sector investment. In addressing Eskom's financial woes, the 2023 budget introduced 254 billion in debt relief to Eskom, subject to strict conditions. This financing will relieve pressure on the utility's balance sheet, enabling it to conduct the necessary maintenance. Finally, to establish and ensure a more reliable distribution of electricity by municipalities, regulations have also been amended to allow municipalities to procure power independently. Secondly, freight logistics. The subpar performance of South Africa's logistics system has resulted in the loss of significant export revenues for the country. Operation Vulindlela seeks to enhance the efficiency and competitiveness of freight transport. The Project Office, operating under the Presidency, has provided an update stating that Transnet Freight Rail has successfully completed the accounting separation between their operations and rail infrastructure units. This milestone is critical as it paves the way for functional separation and the establishment of an independent infrastructure manager, hopefully by the fourth quarter of this year. Such measures will facilitate transparent and accurate pricing of slots on the freight rail network, promoting fair competition between public and private rail operators. Transnet is also making strategic moves to address its deteriorating operational performance by promoting private participation in 2 of South Africa's container ports. Thirdly, water reforms. Reforms in the water industry aim to increase investment in the maintenance and construction of water infrastructure, as well as to improve water quality. Via the successful reinstatement of the Blue Drop, Green Drop, and No Drop water quality monitoring systems, government will ensure that water sources are protected, wastewater treatment plants are functioning, and leaks are fixed. Moreover, the project team has been successful in reducing the backlog of water use license applications. This improves the ease of doing business in South Africa. More than 70% of applications are now being processed within 90 days. Operation Vulindlela is also currently engaged with revisions to the raw water pricing strategy. This should address suboptimal pricing and the financing of water. It should also pave the way for more investment in the agriculture and mining industries in particular, as more certainty around these outcomes are created. Fourth, digital communications. Reforms in the digital communications sector will reduce the cost of data, expand internet access to low-income households in outlying areas, drive new investment in telecommunications infrastructure, and unlock gains in the knowledge economy. Spectrum frequency is a finite resource and must be allocated efficiently to increase network speeds and reduce costs. The auction of high-demand spectrum, completed in March last year, is expected to facilitate these gains. The switch-off from analog to digital transmission is required for the conclusion of the spectrum auction process with the use of other network operators. However, Operation Vulindlela has reported that a majority of provinces have already completed this migration. Fifth, reforms to the visa regime. Lastly, there was a need to improve the regulatory framework to create a more conducive environment for attracting skills and enabling companies to invest in South Africa and supply the skills that the economy requires. Under the guidance of the Project Office in the Presidency, a revised critical skills list has been published to address the change in skills requirements. Moreover, reforms to the visa regime were needed to promote tourism, which is a large driver of employment, particularly for small businesses in South Africa. The successful implementation of the e-visa system now serves 34 countries and should facilitate growth in the tourism sector. Tourism is a quick and easy way to create jobs for relatively unskilled persons. Growing this industry can establish a strong multiplier effect on the economy. Meanwhile, further work is being explored to expand visa waivers and establish a points-based system to introduce greater flexibility into the visa process. These concrete reform efforts are firmly underway, in spite of an uncertain political future. Support for the ruling party has waned in light of economic deterioration and perceived widespread corruption. Policy confusion and political uncertainty have prevented South Africa's business community from expanding, hiring, and investing. At the start of this year, more than 90% of manufacturers, the highest on record, stated the political climate was the key reason deterring additional investment in the local economy. Moreover, the private sector is reluctant to partner with the state, given a widening of the trust deficit in relation to government's financial and operational maladministration, particularly evident at our state-owned entities. That said, there has been an easing of investor anxiety towards South Africa in some areas where radical economic transformation proposals have been vastly watered down, namely expropriation without compensation, the nationalization of the Reserve Bank, and prescribed assets. Nevertheless, government could still do itself a favor by spelling out its goals more clearly to further reduce policy uncertainty and to reignite confidence in the long-term sustainability of South Africa as an investment destination. In conclusion, while long-term investment to the development of any nation revolves around building productive capacity and developing its human capital through enhanced outcomes in the health and educational space, shorter-term measures by government are necessary. The so-called low-hanging fruit or quick wins we have outlined, in addition to arresting increasing lawlessness and encouraging accountability, are vital in stimulating private sector activity. In turn, this has the potential to ease socioeconomic pressures and reduce joblessness, inequality, and poverty through an increase in employment, boosting living standards, and advancing social inclusion. South Africa faces a grave challenge in fostering an economic recovery in difficult global and local conditions, the latter which has been marred by a disintegration of a shared and coherent political, social, and economic vision for the country. This is not the time for complacency. If authorities act quickly to promote these low-hanging opportunities by creating an enabling environment for more private sector participation, increasing competitiveness in the country's product and labor markets, restoring the integrity of South Africa's democratic institutions, and reducing corruption, we could get the economy going again. Let's not forget that South Africa has enormous potential, supported by its diversified economic structure, an abundance of natural resources, deep capital markets, a first world financial system, strong institutions such as the Reserve Bank and an independent judiciary, and free media. Even though some of government's functions are failing to provide adequate infrastructure and services on which the economy depends, South Africa is not a failed state. Significant inroads continue to be made by government, business, and civil society. There are increasingly more examples of role players outside of government that are plugging the holes left behind by the state. This augurs well for a better future for our country. In our view, the scope for the private sector will increasingly widen, whether the incumbent government allows for it or not. Moreover, recent initiatives to improve governance and strengthen public institutions, coupled with tangible progress in key areas of structural reform under the direction of Operation Vulindlela, are indeed steps in the right direction. While these efforts need to be complemented by fiscal policies that stabilize debt and need to be backed by re-established business confidence, there is enough progress to suggest that South Africa may yet spring a positive surprise to steer this economic ship in a different direction. Thank you for your time.
Thanks for sharing such great insights, Anisha. Next is Herman van Papendop, our Head of Investment Research and Asset Allocation, who will propose that two of the main themes paramount for portfolio positioning will be the probability of US recession and the peaking of US policy rates. Pleasure to have you join us today, Herman.
Thanks, Michael, and hello everyone. It's great that you could join us today for a discussion about the current importance of the two R's for portfolio positioning: US recession and rates. As far as the main global themes driving the outlook for financial markets are concerned, we think the likelihood for US recession, the first R, and the US policy rate cycle, the second R, are paramount for portfolio positioning in the next year or so. Let's start by discussing the first R, US recession. We think the outcome of the recession theme will determine whether or not there is substantial downside risk for global equities from here. Although the debate about the probability for US recession has been ongoing since the latter part of last year, the jury is still very much out on whether we'll see a US recession in the coming quarters or whether a recession can be avoided altogether. Although the balance of evidence in our view currently points to a better than even chance that we will see a US recession either later this year or in the early part of next year, there is still a significant possibility that recession might not happen. We think there are four main indicators that currently point to a meaningful probability for US recession. Firstly, the monetary transmission lag. Since the US Central Bank started its hiking cycle in March last year, policy rates have increased more over the last 12 months than at any time since 1981. If policy works with a 12 to 18 month lag, as it typically does, the full effect of all of this tightening on the US economy is still very much to come, even if rates are now approaching their peaks. And since the starting point for interest rates was close to zero, one can argue that the rate hikes in the latter part of the hiking cycle could be disproportionately more detrimental for consumers and businesses than increases earlier in the cycle. The risk is that the mounting cumulative impact of the sequential rate increases later in the rate cycle, in retrospect, could turn out to have been the proverbial straw that broke the US economy's back. The US leading economic indicator provides the second warning sign for possible US recession. Momentum in this composite indicator, which includes 10 variables across the US manufacturing sector, labor market, housing sector, the equity, credit and rate markets, as well as consumer sentiment, has gone significantly negative, as shown in the blue line on this graph. I've also shaded the periods of official recession in the US on the graph, and you can see that never before, across 60 years of history, has the leading economic indicator momentum been this negative without a recession following. So, this would be one of the arguments that the bears on the US economic cycle would put forward that a US recession is coming. A third potential signal for an oncoming US recession is the significant tightening in lending standards undertaken by US banks since late last year. This is depicted here by the dark blue line on this graph. Banks' lending criteria were pretty loose in the aftermath of the pandemic of 2020. But as banks became worried towards the back end of 2022 that consumers and businesses were coming under strain from higher interest rates, they started tightening lending conditions. By limiting the availability of finance for the US corporate and household sectors, this increases the risk for a sharp slowdown in US economic activity or even recession in the quarters ahead, as lending criteria have typically led US GDP growth, shown inverted here in the light blue line, by around 2 quarters. By limiting the availability of finance for the US corporate and household sectors, this increases the risk for a sharp slowdown in US economic activity, or even recession, in the quarters ahead, as lending criteria have typically led US GDP growth, shown inverted here in the red line, by around 2 quarters. Fourthly, the 3-month 10-year US yield curve inversion has been an infallible recession indicator historically, never giving a false signal. Whenever this part of the yield curve inverted in the past, we have always seen a recession following, and the recession ensued somewhere between 5 months and 16 months after the yield curve went into inverted territory. This time, the inversion date was October of last year. So from October last year, the shortest time span of 5 months to recession in history would have implied March this year for the recession start. Similarly, the longest time span has been 16 months from curve inversion to whenever the US went into a recession, which implies February of next year for the recession start. On average, the recession started 10 months after curve inversion, which would imply the US recession to start in August of this year. So, in summary, you'd say that somewhere between March this year and February next year, the yield curve inversion would predict that there will be a recession in the US, and on average it should be somewhere around August. One indicator that has often given false signals about US recession in the past has been the US Manufacturing Purchasing Managers Index, the PMI. As a diffusion index, whenever this falls below the 50 level, it is indicative of a looming contraction in US manufacturing activity. Since this indicator has been below the 50 level since November last year, it is often referenced as pointing to a forthcoming US recession. However, since this indicator is only reflective of the shrinking US manufacturing sector that now constitutes only slightly more than 10% of the economy, it is unsurprising that it has given so many false recession signals in the past, and as such is not a trustworthy recession indicator. Now, of course, it is possible that this time could be different, and the seeming infallible recession indicators like the US Leading Economic Indicator and the inverted yield curve could be wrong for the first time. But one would be betting heavily against history if you make such an assumption. So, as responsible custodians of our clients' money, we think it is more prudent to assume that there is a significant probability that there could be a US recession, and that this has important implications for how portfolios should be positioned. Let's explore why it's so important to financial markets and portfolio positioning whether there will be a US recession or not. Well, if a recession can be avoided, the downside momentum in the US economy would be contained and the equity market could chug along, even if returns could be unexciting at times. In the absence of recession, portfolios would not have to be positioned very defensively to limit downside risks, and exposure to growth assets would feature more prominently in asset allocation. Conversely, history has shown that whenever there was a US recession, it was associated with significant drawdowns in the US equity market. Indeed, as this table shows, the US equity market has never bottomed before a recession started, but always after it began. So, if we do get a recession this time, we haven't seen the bottom of the US equity market yet. For future asset class performance, it obviously also matters whether markets are already discounting recession or not. Let me highlight two factors that seem to indicate that the US equity market is currently not expecting a recession. Firstly, if we look at the so-called fear gauges for the US equity and bond markets, it is surprising that the US equity volatility indicator, the VIX as depicted by the blue line in the graph, is currently indicative of the lowest equity volatility since pre-COVID, at a time that there are huge uncertainties about US growth, inflation and policy rates. Contrast that with the current US bond market volatility indicator, the red line in the graph, that has settled at an elevated level. It thus seems that the US equity market is much more complacent than the bond market about the economic outlook. Secondly, expectations for US corporate profits also don't seem to be reflecting a recession scenario. The table shows that in the previous 7 recessions, the average and median peak to trough declines in earnings were 24% and 18% respectively. The current consensus expectation is for a 5% peak to trough earnings decline this time, well short of the historical recession experience and pointing to likely sharp profit downgrades should a recession materialize. So that's why we think one has to be somewhat circumspect about equity markets and portfolio positioning when the balance of probabilities is pointing to a meaningful chance of US recession, but the equity market doesn't seem to attach a high probability to this. We therefore need to protect portfolios against the potential downside risk for the US and global equity markets, because if we do see a US recession, then global equities could still go down significantly from where we are trading at the moment. In our view, it does make sense to favor exposure to US bonds, gold, and alternative assets like infrastructure as portfolio hedges against potential downside global equity risk. However, not only does it make sense to favor an allocation to US bonds as a portfolio hedge against potential recession risk, but US bonds also look attractive from a rate cycle perspective and a relative valuation angle. This is then an opportune moment to discuss the second R, the US rate cycle, and its implication for relative asset class performance. It currently looks likely that we will soon see the peak in US policy rates as inflation declines to levels the US central bank would be more comfortable with. How did US equities perform around past rate peaks? Well, over the past half a century or so, it depended on whether inflation was high or low at the time of the rate peak. US equity returns were only high subsequent to past rate peaks when inflation was low. Whenever inflation was high, like now, the subsequent US equity performance after the rate peak was pretty poor. This makes sense because when inflation is high, you typically don't see a pivot to rate cuts very soon after the peak in interest rates. So, if inflation remains at high levels for the next 6 to 12 months, we won't see the Fed cutting rates and equities could perform poorly. But if inflation drifts down closer to the Fed's implicit target, then we might see the first cut early next year, with positive ramifications for equities in the run-up to the first cut. Again, this calls for circumspection about equity market performance in the US around the rate peak, this time in a high inflation environment. This slide shows that US bonds in red historically strongly outperformed developed market equities in blue in the year following the peak in US policy rates during cycles when the yield curve was inverted, as is now the case. The maximum outperformance was as much as 11.5% during the year. So this tells you that normally you would want to favor US bonds over equities in the year after US rates peak when the yield curve is inverted. Furthermore, sharp global policy rate rises in 2022-2023 have caused the largest increase in US cash and bond yields in 40 years. As a result, US fixed income assets, cash in red on the graph and bonds in blue, have again become viable income providing alternatives to equities in grey. The last time this was the case was in 2007, before the onset of the global financial crisis. So nowadays, investors can again get investment income from fixed income assets as it's normally supposed to be. Whereas for more than a decade after the global financial crisis, cash and bond yields were so close to zero that investors' only income alternative was to explore the equity asset class for better income from dividends. Finally, after the sharp rise in bond yields and the strong equity performance in recent years, US bonds are now attractively valued relative to US equities. When you compare the current bond yield to the through-the-cycle equity earnings yield, bonds are now almost one standard deviation cheap relative to equities against history. This was not the case for a long time since the global financial crisis, when equities were consistently cheap versus bonds, with the red line trading below the average. So let's summarize our thinking. We think that two of the main themes that are likely to be vital for portfolio positioning in the next year or so will be the probability for US recession and the peaking of US policy rates. Although US recession may still be avoided, there are enough indicators pointing to a reasonable likelihood that a recession could transpire, which would imply a risk for meaningful global equity market downside, particularly as the US equity market doesn't seem to attach a high probability to a recessionary outcome. As such, it is prudent to position portfolios somewhat defensively by favoring exposure to US bonds, gold, and alternative assets like infrastructure as hedges against the potential for sharp equity drawdowns. However, not only does it make sense to favor an allocation to US bonds as a portfolio hedge against recession risk, but US bonds also look attractive versus global equities from a rate cycle perspective and on a relative valuation basis. In the past, whenever inflation was high, like now, at the time of a peak in the US rate cycle, the subsequent US equity performance after the rate peak was pretty poor. Furthermore, US bonds historically strongly outperformed developed market equities in the year following the peak in the US policy rates during cycles when the yield curve was inverted, as is now the case. In addition, sharp global policy rate rises in 2022 and 23 have caused the largest increase in US cash and bond yields in 40 years. This has once again made US cash and bonds appealing income providing alternatives to equities and has caused US bonds to now look attractively valued relative to US equities. We thus think it is currently prudent to position portfolios somewhat defensive while there is still significant risk for a US recession on the horizon. The historical superior performance from US bonds over global equities at the peak in the US rate cycle, whenever inflation was high and the yield curve was inverted like now, together with the better relative valuations of US bonds versus equities, further add to our favorable disposition to US bonds in our portfolio positioning. In closing, let me paraphrase the catchphrase with which Sergeant Phil Esraz ended each morning's roll call in the 1980s cop TV series Hill Street Blues. For now, in our portfolios, let's be careful out there.
Thanks, Herman. Definitely one space to keep an eye on. And now, our Chief Investment Officer, Mike Atzet, in a dialogue with Colin Graham from Robeco, will unpack how evolving macroeconomic global trends will affect the opportunities and risks for global investments. Welcome, Mike and Colin.
Thank you, Mike. And thank you, Colin, for joining us. Now, I have a question for you. Globally, we've seen interest rates starting to get toppish and starting to roll over. Inflation itself has also started to drop off, but not really at the pace that we'd been anticipating a year ago. So it really seems to be a little bit stickier. So a question I have for you is the higher interest rate and the high inflation environment. Do you see that as a structural phenomenon or a cyclical phenomenon?
Well, I think it's very difficult right now to disaggregate the two because I think they're both working in the same direction. But for us, when we look 5 years out in our 5-year outlook, we are putting higher inflation rates in on average over the next 5 years than you've seen over the last 5 years or indeed the last 25 years. So yes, we think that inflation needs to be higher. And I think that this goes to the idea around volatility of economic growth. And I think that's going to be higher going forward as well. So if you took those two things together, then you really have to think that inflation has to be higher because every time you go into recession, you're going to be in fear of a deflationary bust, which is something that central banks don't have the tools to fix, as we have seen for Japan.
The issue of whether interest rates and inflation is structurally or cyclically higher is an important consideration in terms of the expected return from different asset classes. Now, if we look at the fixed income complex, that is becoming far more investable, but there are other asset classes that become less investable going forward. As a manager of multi-asset portfolios from a global perspective, what you're thinking in terms of the investability and the opportunity set and the risks associated with the different investment opportunities that you've seen at the moment?
Yeah, I think, following on from your first question, Mike, I think the biggest opportunity we see is that the consensus is that inflation is going back to the 2% target that central banks talk about. We don't think that. So again, answering your other question about structurally higher inflation, then yes, we have to accept that. But what does that mean? That means that cash rates will no longer be zero. So therefore, it is an alternative. So we've moved from a world of TINA, where there was no alternative than equities, to one where there are reasonable alternatives. So cash. The long end of the bond curve are 200 basis points higher. However, there isn't necessarily value there if you think inflation is going to be 3% over the next 10 years. So that's something we have to be a little bit more concerned about and only invest when we think that the global economic slowdown is going to happen. So therefore, rates will be cut in the future. So inflation has remained remarkably stable, the expectations around inflation, and that's why you see the shape of the yield curve to be so inverted, where shorter dated yields are much, much higher than longer dated yields. So again, at the short end of the yield curve, the 2-year end, the 1-year end, you're getting much higher rates than you are if you put your money out saving for longer time. So yes, there are many alternatives to equities, but it's cash and short dated bonds. If we move over to equities, then I think that the high nominal economic growth has supported equities. However, interest rates need to go up to tame inflation. So there comes a point, a tipping point, where higher rates will cause economic slowdown, and that's what equities will not like. You'll see an earnings recession, which, yeah, as you know, Mike, when we talked earlier in the year, we were concerned about, and therefore we're being more defensive in our multi-asset portfolios. But we've continued that in terms of being underweight equities. We're overweight emerging versus developed markets, just on valuation, but also the fact they have more room to cut interest rates, whether it be Latin America or indeed, as we're seeing in China as well. So we see lots of different areas. And again, if we think about currencies, we can see that why the dollar should weaken, given that the US was the first to raise interest rates and go very hard, but that's going to moderate. So you're going to see the other economies catch up, and the dollar is very, very expensive, especially against the yen. It's like a 40-year high against the yen. So you would expect that the dollar to start to weaken over the next few years if you have that sort of time horizon.
Yeah, so I suppose the big question, and one of the perspectives I'm very keen to get your opinion on, is the risk of US recession, or they call it globalization or slowdown. An inverted yield curve is invariably an indicator of recession, but with the US job numbers, it doesn't seem to be quite getting there, although caution is warranted. What's your base case view? What are the things to watch out for, and how do you think this plays out over the next 6 months, 1 year?
Yeah, I think that our recession call has been delayed following the liquidity boost, or central banks propping up regional bank in the US. So you saw the central bank's balance sheet start to rise again when you saw the regional banks get into trouble. So that's, again, provided liquidity. And I think that's the key element you have to watch for your equity and higher risk parts of the market, like high yield, because once that dries up, then there's less push into the riskier end of the investment spectrum. So we continue to watch things like the money multiplier. So that's where that's sort of broad money versus cash. So that takes into consideration credit cards and people spending on the never. We'd also look at how credit conditions are tightening. So senior loan officer survey. Some other central banks do similar surveys. So just looking at seeing if banks are tightening their conditions for lending. You've seen mortgage rates go up. That's affects certain countries more than others, of course. But in the US, not so much, because everybody's 30-year fixed at 1.5%. So unless you're going to move house, then you're pretty insulated from rising interest rates in the short term. But then, if employment doesn't come down, then inflation is not going to come down, because this is an aggregate demand. If you have more people working and getting wage rises, then there's going to be more spending. And we know that the economy is still quite supply constrained. There's a positive output gap. So the US economy is running ahead of its natural rate, so therefore it's causing inflation. So in our view, the Fed will have to do more. And when Jamie Dimon, the head of JP Morgan, came out of the FOMC meetings and went up to the Hill, he came out and said, well, I expect US interest rates to go to 7%.
Yeah.
And that's not in anybody's core scenario.
Yeah. And I mean, the higher interest rate has substantial implications, as we've spoken about, for traditional asset classes, but alternative asset classes historically have also been one of the places that globally investors have been able to seek some shelter. Now, a lot of the different asset investment types within the alternative complex have relied on low interest rates. I'm thinking about private equity and gearing in property. So I just want to get your view in terms of the sustainability and investability of things like private equity within the alternatives complex, which is becoming more difficult to invest in. And then we've also seen a groundswell in infrastructure investment, which in theory should have similar constraints on it, but because of the massive backlog in infrastructure development and the huge demand for alternative energy, they are becoming more popular. What are your perspectives in terms of the alternatives complex?
Yeah, I think that you can split it into two areas. One where financial gearing has helped generate returns. So if you think of private equity and private debt, then you see those have been one of the biggest beneficiaries of zero interest rates and loose monetary policy, plentiful liquidity. So those are the areas that we are avoiding. On the other side, the physical projects that have revenues linked to inflation, which a lot of infrastructure does, where admittedly it'd be capped, but there will be inflation increases included in the revenue stream, future revenue streams. So those sort of projects would be pretty attractive if you could buy the debt or indeed the equity of those. In terms of commercial property, I think that it's not just the higher interest rates that these companies are dealing with. It's actually the changing in working environment. And do you need to have as big offices as you did in the 2010s, given that people are working 2, 3, 4 days at home?
Yeah, I mean, change is also another theme that really is front and center at the moment. And for many years, the growth in China has been one of the big stories, and that's had an impact and impetus in terms of the rest of the world. But I mean, the Chinese economy is massive now, and it cannot realistically sustain the high levels of growth that we've seen in the past. That's one component of the conversation. The other component is almost the challenger status of China on the global stage and the geopolitical implications that that has had in the world. How do you view the growth of China, the geopolitical landscape, and some of the tensions and frictions that we're going to start seeing on global markets as a result of that?
Sure. So we've never subscribed to the US rhetoric around China is uninvestable. Of course, it's investable. You just have to look at what returns you're going to be generating. And as with anywhere else in the world, if you're investing alongside your government, you mentioned the infrastructure, the energy transition. If you're investing alongside a government, then you should be okay. And I think that goes the same whether you're in the US, Europe, South Africa, or indeed in China. So that's a key element. In terms of the growth rates, then I think investors have got frustrated because they haven't returned to the bad old ways of just building property and goosing the economy through cheap money and infrastructure build. But actually, longer term, that's a positive because you can see that that's going to transition the economy away from this manufacturing, property, infrastructure-led economy into a more service-orientated economy, which it needs to do. And then you think, okay, even if growth rates come down to 3% per annum for the next 10 years, that's equivalent of adding India to the global economy. So yeah, the 5% to me is spurious. You have to think about, okay, this is a big economy and it's going to continue to grow. It's probably in recession now. The valuations are incredibly cheap, and it's just like you're being compensated for the risks that you're taking in China. You couldn't say that 3 or 4 years ago, so now you can. On the other side of that, then you also have to put a risk premium on. You mentioned about this deglobalization. I think you have to have another risk premium, which we haven't really had to deal with, where we were in the sort of unipolar world of the US. Now we have a challenger to the US in terms of the economy, in terms of the military might, in terms of the impact it has on other countries, whether it be in Asia or Africa or South America. So there is competition there, and you can see that that is beginning to affect various investments, various companies, the source of minerals that we've never heard of that are incredibly important in your iPhone. These types of things where we're going to have to think about this a bit harder. And therefore, anytime you have this sort of bipolar world, then you do get a risk premium built into risk assets because you have to assess it through that lens. We, as I said, we're overweight emerging markets. We think that the valuation is cheap enough, but again, what the catalyst is to get to change sentiment domestically in order to start buying equities, I think that's the key element, and that's what we're watching in China.
I mean, ultimately, we need to figure out a way to work together. China's got something like 60% of global reserves of lithium. There's no energy transition or battery storage without China. It's such a big component of the global economy. So how the world reconfigures, and I think that's a big question. There's a reconfiguration that's happening at the moment. And early in the conversation, you mentioned your view about a weaker dollar, and also with the deglobalization and the regionalization of some of these big economies, the questions coming up more and more around alternative reserve currencies. Part of the might that the US economically has been able to project around the world is as a result of the US dollar's dominance. As we've seen with actions against Russia as a result of the Russian-Ukraine war, there's been a weaponization of the US dollar, and that has profound implications and has created another risk that central banks and sovereigns around the world are thinking about. Now, I just want to get your view around the role of the US dollar as a reserve currency, and what are the trajectories and what's the time frame for any potential changes to the status of the US dollar as a reserve currency, and what's at the moment there's in the short term no viable alternatives, but what would you be looking out for?
Yeah, I think you hit the nail on the head there, Mike, in terms of this is a long-term structural change that's happening, and what has changed and why the dollar is going to struggle to be the reserve currency is because the US has weaponized it in using it in terms of sanctions, in terms of not allowing people to trade through that. So you're already seeing countries go around this. You're seeing contracts for oil, for example, written in yuan. So instead of dollars, which was the base currency normally. So you're already seeing this, and I think you're going to see more of that. But so at the moment, I think both the structural and the cyclical pointers are telling you the dollar should be weakening. So I can imagine in a year's time we could be sitting here and everybody's saying, "Oh, the dollar is over." Yeah, I wouldn't subscribe to that. But we're going to go all the way through to the other side of the argument to say, okay, the dollar's no longer the reserve currency. That's not going to happen in the next 5-10 years. It's going to happen over time. So as Mike, we've been discussing about central bank coins. I think COVID has accelerated this, and I cannot remember the last time I've actually paid for anything in cash, hard cash. You always use my card. So effectively, most people are already there using electronic money, and it's just a case of who do you trust to actually back the coin? Do you trust the central banks, or would you have a more diversified backing of, say, a Bitcoin or an Ethernet?
Yeah, thanks. That's all the time we have for Colin. Thanks again for your global perspectives. I always enjoy our conversations with you. And as you rightly point out, there are changes in the world. Investments that historically weren't investable, such as bonds and cash, are becoming more investable. And there's a realignment of the global order. So it's really something to be alert to and watch out for. And ultimately, that's going to give investors investment opportunities, but you need to be alive to the risk that's associated with that. So audience, thank you very much. Really enjoyed the conversation with Colin and an opportunity to speak to you. And we look forward to chatting to you again soon.
Thanks, Mike. Thanks for your time.
Thank you for a very impactful discussion, gentlemen. Karabo Siemo, one of our fixed income fund managers, will shed some light on the resilient characteristics of the credit asset class and the reasons why investors across the world seek out this asset class. The stage is yours, Karabo.
Thank you, Mike. Hello, everyone. Today I'd like to chat to you about an asset class that has proved itself quite resilient in a market that has been very volatile, the credit asset class. It has consistently provided investors with stable, uncorrelated returns in excess of the inflation rate. However, as there's limited research into this asset class, it's resulted in a number of myths and generalizations circulating around them. One of them being rising interest rates are a significant threat to the asset class. Our response to that is that credit assets are actually structured to be somewhat interest rate resilient. Firstly, South African credit assets are predominantly floating rate in nature, so therefore there's no risk of declining valuations as a result of interest rate movements. Secondly, it's an accepted standard that companies borrowing in the credit markets have to maintain an interest coverage ratio of at least 2.5 times. Failure to do that is an event of default under loan facilities. And cross-default provisions ensure that even your covenant-light corporate bonds benefit from such a trigger. So to protect themselves and to avoid simultaneous acceleration of all their debt, companies generally operate at sizable buffers to this trigger point. Other myths include there is no growing sectors in the South African economy. Rand hedges only reside in the largest listed companies. Slow economic growth will lead to higher defaults, and middle market and private companies are risky. I'm hoping that through this presentation I can shed some light on the resilience of the credit asset class and highlight reasons why investors across the world seek out this asset class as a haven in times of volatility. I also want to share our views on why we believe the private debt segment of the asset class delivers the most value on a risk-adjusted basis, noting that our definition of private debt excludes distressed and special situation debt. The reality is a vast majority of companies across the world are privately held and they are not well researched. As at the end of 2021, it's estimated that only 17% of companies worldwide were listed. Therefore, providing credit to private companies, an activity that has historically sat on the balance sheets of banks and life insurance companies, is a massive and diversified opportunity set that investors ignore at their own peril. Certain sectors and structures are just not available in the listed market, and the listed market is dominated by covenant-light unsecured securities. According to Moody's, the Ba2 global scale rating is the average default rating for the entire middle market segment. Post the global financial crisis, the credit loss rates for the BA rating band has remained below 30 basis points. This compares very well with the credit loss ratios that South African banks have recorded on average post-2020, which has been at 90 basis points. Therefore, on average, lending to the middle market segment is 3 times less risky than the lending activities of South Africa's 5 largest banks. Amongst our suite of fixed income funds, we have the Momentum Income Plus Fund, a fund that aims to deliver alpha to its investors by maximizing its private debt exposure to the middle market. The private debt exposure sitting in the Momentum Income Plus Fund carries an average rating of Ba1, 1 notch above the market average, due to, amongst others, the secured natures of the exposures in this fund. Approximately 70% of the securities that sit in this fund, both public and private, carry a rating higher or equal to the BA rating band. Other private debt activities also fall into the B rating band. This band exhibits limited losses in normal market conditions, having recorded a loss level of 70 basis points in 2021. This is lower than the credit loss ratios of the 4 biggest banks in South Africa. Volatility in losses in this rating band is limited to periods of market shocks, for example, pandemics and the global financial crisis. The highest loss rate since 2009 in this rating band was in 2020 at 2.6%, which was 1.5 times higher than the credit loss ratios of South Africa's largest banks. Such loss rates are manageable and are also sufficiently covered by the credit spread that one can earn on assets in this rating band, which is generally north of 300 basis points. So, defaults will always be there in the credit markets, but in the absence of market shocks, we expect the losses to remain at historical averages. 20 basis points for the BA rating band, 1% for the B rating band. Credit investments are predominantly medium-term buy and hold investments, and changes in macro environments are expected to occur over the investment period. Therefore, when lenders make their investment and pricing decisions, they make them on a through-the-cycle basis. There are many opportunities in the middle market and private segment to fund well-managed cash-generative companies operating in growing industries. and we have shown that they are not necessarily risky. An additional benefit of investing in the private and middle market segment is that securities here are predominantly structured as bilateral loans. And based on 42 years of data, Moody's has found that recovery rates for bilateral loans, both secured and unsecured, are 1.5 times higher than those for the unsecured public market bonds. These high recovery rates are driven by, amongst others, the close nature of the relationship between the borrowers and the lenders, as well as the embedded structural protections like financial covenants, which allow both the borrower and the lender to proactively address any potential issues early in the process and ultimately result in lower levels of defaults in the market. Another benefit of investing in the middle market segment is that in many cases, the revenues of these entities are backed by medium to long-term contracts with blue chip companies and utilities domestically and in some instances offshore. SMMEs across the globe have recognized the importance of internationalizing to enable growth, though some of these plans have been delayed by the pandemic and the resultant supply chain challenges. The South African public debt market has stagnated for more than a decade, and the majority of the activity that we have seen here has been limited to refinancing activities around existing debt. This has been driven by the lack of investment in the country by the largest listed companies. However, the private market continues to grow, supported by record high levels of liquidity amongst private equity and private debt funds. 2022 was the second best fundraising year for both these markets after 2021, with the AUM across both growing at 20% per annum since 2017. Dry powder in the international private equity space exceeded $3 trillion by mid-2022, while it stood at approximately $40 billion for South African private equity. Private debt funded more than 80% of private equity transactions in the middle market segment in 2022, amounting to approximately $2.4 trillion, making 2022 the most active year for this asset class. The diversity of strategies in the private markets, which include private equity and private debt, has increased the resilience of both these markets. In the current high interest rate environment, mezzanine debt strategies in private debt have doubled to $30.1 billion, while private to public strategies in private equity space are starting to dominate activity. In the current environment, where interest coverage ratios of companies are starting to decline and other lenders are becoming more conservative, mezzanine debt is infusing liquidity into the market and enabling continued deal activity and therefore continued growth in the private markets. Mezzanine debt is very supportive to companies by allowing them to preserve their cash flows, as it can be issued alongside existing debt without triggering refinancing or repricing, and also has various mechanisms that can allow interest payments to be deferred in times of stress. Globally, higher interest rates, amongst other things, have resulted in a significant decline in public company valuations. Locally, macroeconomic headwinds and other structural challenges over a period of more than a decade have also resulted in cheap public market valuations. Such conditions have created favorable conditions for public to private transactions, which allow access to seasoned companies that are temporarily mispriced. In South Africa, cheap valuations have led to approximately 22 companies per annum being delisted from the JSE over the last 14 years. The Momentum Income Plus Fund has been able to participate in a recent delisting of a 34-year-old ICT company, which has a presence across the continent and a client base that includes blue chip companies at very favorable pricing. Interest rate hikes did not only hurt listed equities, but they also reduced the rate of unicorn creations as well as their valuations, although not as much as in the public markets. In the current environment, investors have become more conservative and are looking for safe bets. And beneficiaries of this change in focus have been North America from a jurisdiction perspective and ICT and energy from a sector perspective. Though the rate of unicorn creation declined sharply year on year, 2022 is still recorded as the second highest annual number of unicorn created in a single year, meaning a healthy pipeline for future private debt deployment for us in the credit markets. In 2022, South Africa saw a year-on-year drop in the number of startups receiving funding and the total amount of funding received. However, the quantum of funding that targeted technology-based startups remained unchanged and made up the bulk of the activities of 2022. The theme of resilience around the technology sector is consistent across the continent, with funding increasing by 8% and debt funding doubling in that space. In the Momentum Income Plus Fund, we seek out opportunities to invest in the technology sector, particularly where we find a confluence between technology and a core sector, for example, data center development. Even in a normalized environment, small and medium-sized enterprises face many challenges, and governments have to create attractive ecosystems that will encourage entrepreneurs to set up shop in their countries. According to PwC, the key drivers that make a jurisdiction attractive include a supportive startup ecosystem, a supportive private sector business landscape, the level of education, skills, and talent in a country, as well as the ESG metrics of a country. Surprisingly, macroeconomics and the tax and regulatory regime of a country have very limited impact on its attractiveness. South Africa has the most promising startup ecosystem on the continent, and amongst 33 EMEA countries, South Africa was ranked 14th in terms of a supportive tax and regulatory environment, 22nd in terms of an attractive ecosystem for startups, in terms of technology, infrastructure, the level of education and skills, and the quality of our healthcare, and was also ranked 24th to 25 in terms of ESG, our landscape for private businesses, and from a macroeconomic perspective. So, though our ecosystem still requires further investment, in addition to the various grants and loans provided by government and local DFIs to startup companies and the various investments in infrastructure, the South African debt market still has a healthy pipeline of transactions for future deployment across various sectors. The sectors reflected in this slide are those that have shown significant innovation and growth and are also the target of majority of the private equity capital and various incentives of government. In looking for opportunities across these sectors, the Momentum Income Plus Fund will continue to avoid highly cyclical sectors and will focus on the reliability of cash flows as well as the quality and the diversification of revenues. So, activity in the lending market can be split into lending to corporates and businesses and lending to consumers. And it's very encouraging to see that the performance overall has remained quite resilient. Using Merton's distance to default methodology, on which Moody's credit edge is based on, we see that the credit quality of both large and mid-cap companies have actually improved since 2019. Though still not broad-based, evidence of strain in consumers' finances is starting to feed through into the credit metrics of South Africa's largest banks. Though one would have expected that such deterioration would be driven by increased extension of unsecured debt to consumers, the performance of this product set has actually remained quite robust. As at 2022 Q3, material deterioration in the performance of consumer credit was limited primarily to short-term credit facilities that are provided outside of the banking sector. Developmental loans, which include student loans, housing development loans, and small business loans, showed small deterioration in performance as well. And this is the kind of debt that would come through from the banking sector. So there are 5 phases to a company's life cycle. The Momentum Income Plus Fund looks to invest in companies in the growth phase, the maturity phase, as well as the public to private phase of their development. At these phases, we have the benefit of investing in businesses with stable and growing cash flows that are often also contracted at attractive yields. And particularly in the growth and the public to private space, we have very strong downside protections. So to conclude, the Momentum Income Plus Fund has a very unique value proposition for both retail and institutional investors. It allows for exposure to a diversified portfolio of investments, more diversified than what's available in the listed market, while providing high income, which is generally 2 to 3% in excess of inflation. Furthermore, it offers insulation from declining valuations, and drawdowns are generally limited to periods of market shock. Even in such periods of shock, the volatility is limited when compared to portfolios of government bonds and listed equities. The fund also exhibits very low correlation with macroeconomic developments as well as traditional asset classes. So as a result, it can provide capital stability through economic cycles and serve as an important building block in constructing robust solutions for clients. We are hoping that over time, regulators will recognize the conundrum of a limited supply from a declining public market and an increasing demand from investors for enhanced, stable, inflation-beating returns that are best served from a growing public market. The credit asset class also offers lower levels of liquidity when compared to traditional asset classes like bonds and equities. So it's better suited for clients with relatively patient capital and who are looking for income. An investment horizon of approximately 3 years is recommended. And lastly, as a result of constrained supply in the listed market, competition is rife and timelines for execution continue to accelerate. This is a challenge as the investment process for the Momentum Income Plus Fund requires a robust due diligence process over and above an analysis of financial statements. Therefore, our approach is to use up our full 10% allocation for private debt. And in respect of the public markets, we do not respond to timelines placed on us by issuers. This means that we are happy to miss certain opportunities where we are not given time to do proper due diligence. We construct a buy list of target companies and we take these companies through our process. Once we are satisfied with the investment thesis of each of these companies, we actively seek opportunities across different markets and not just our local market. And that's my time. Thank you.
Thanks, Karabo. You certainly added lots of color to the credit asset class. Really informative stuff. Up next is Lofty Botha, our head of Smart Beta, who will demonstrate how factors recently converged as trending, value and quality strategies all simultaneously underperformed.
Thanks, Mike. Hello, everyone. Today, we are going to share with you how popular smart beta or factor investing has become over the last decade. We are also going to discuss how cyclicality is part and parcel of smart beta investing. While volatility is the short-term price that we pay for long-term performance, we can materially reduce this volatility by diversifying over different style factors. But even after diversification, a component of residual risk remains, albeit at a lower level. This is because factors may sometimes converge to lag simultaneously. Finally, we are going to illustrate that periods of underperformance are usually followed by periods of strong outperformance that more than compensate for these lags. Smart beta products experienced explosive asset growth over the last decade. In the United States, for example, factor ETF assets grew by 25% per annum. This growth is mirrored in South Africa. While the local general equity unit trust category grew by only 10% per annum, the component of smart beta funds contained therein grew by 29% per annum to around 18 billion by the end of last year. Momentum, with its 6 billion suite of smart beta unit trusts, has around a third market share in this space. We launched our trending value and core equity unit trust in April 2017, and in August 2021, we enhanced our offering by launching the Momentum Quality Equity Unit Trust. While the main driver of success of smart beta products is the pleasing returns, the second driver is that these products enable investors to reduce risk by diversifying across different factors. This is because different factors usually peak and trough at different times, but more about this later. Smart beta funds do not require expensive research teams to run and hence are offered at lower fees. And we all know how material the benefit of this is over the longer term. While smart beta investors enjoy the lower costs that are associated with tracker funds, they also have the upside associated with traditional investments. These dual benefits often lead to switches from both trackers and traditional investments into smart beta funds. And as more and more investors learn about the benefits of these products via the media, the strong growth trajectory is likely to remain intact. Let us turn to our own products. The Momentum Trending Equity Fund invests in winners. Investors in this fund believe the trend is your friend and cut your losses and let your profits run. It is well known that shares that performed well in the recent past continue to do well. This can be explained by the concepts of anchoring and herd behavior. Anchoring happens when investors get anchored to historic perceptions. They tend to react slowly to new information and share prices initially underreact. As things become clearer, they react more and more in line with new information, and this causes a trend. And due to herd behavior, leading market participants start and followers extend the trends that this fund aims to exploit. There are times, however, when trending strategies struggle to perform in a highly turbulent environment, such as what we recently experienced due to the 3 supply-side shocks, the COVID crisis, the Ukraine crisis, and problems at Eskom. Trends temporarily disappeared and these strategies underperformed. However, things always normalize. Unknown unknowns become known unknowns, and exploitable trends start to reappear. This chart shows the rolling 12-month performance of our trending strategy relative to each benchmark. We use backtested figures up to April 2017 when our product was launched and actual figures thereafter. While the average performance is attractive, there were sometimes periods of material underperformance. However, these were typically followed by periods of strong outperformance. The chart also shows how the strategy can lag the benchmark by more than 10% in turbulent times, for example during the global financial crisis and recently during the COVID crisis. Given the cyclicality of this product, the right thing to do is to manage client expectations down during peaks and up during troughs. Despite the cyclicality and recent lag in performance, the Momentum Trending Equity Fund delivered stellar performance since its launch back in April 2017. The Momentum Value Equity Fund buys stocks that trade at bargain prices. Opportunities arise when shares overreact on bad news or when themes or sectors temporarily fall out of favor. Warren Buffett describes the value philosophy well. Price is what you pay and value is what you get. We aim to buy low and sell high by considering a number of widely used valuation metrics. While value investing may require patience, investors usually get rewarded handsomely once share prices start to move closer to fair value. Value strategies sometimes struggle in a risk-off environment. Due to fear, cheap stocks may become cheaper. However, from these lower levels, they offer even more value. This chart shows the rolling 12-month performance of our value strategy relative to each benchmark. We again use backtested figures up to April 2017 when our product was launched, and actual figures thereafter. The behavior is similar to what was experienced with the trending strategy. Average performance over the total period is attractive. Periods of underperformance again occurred during times of uncertainty and were also typically followed by periods of strong outperformance. Despite the cyclicality and the recent lag in performance, the Momentum Value Equity Fund delivered sterling performance since its launch back in April 2017. The Momentum Quality Equity Fund invests in well-managed companies. Henry Ford used to say that quality means doing the right thing when no one is looking. We believe that if quality is ingrained in a company's DNA, it would show up in key measures for profitability and stability. If a company scores well on these measures, it should be able to generate superior earnings growth on a consistent basis, and this would lead to superior share price performance. While in the long run well-managed companies do outperform, the reality is that from time to time there are periods when short-term fears dominate share price behavior, with the result that well-managed companies temporarily get overlooked. However, tough companies last and tough times don't. This chart shows the rolling 12-month performance of our quality strategy relative to each benchmark. Backtested figures are used up till July 2019 when our segregated product was launched, and thereafter we use actual figures. The behavior is similar to what was experienced with the trending and value strategies. Average performance over the total period is quite attractive. Periods of underperformance typically occur during times when short-term considerations dominated share prices. However, these were normally followed by periods of strong outperformance. And the same three consecutive supply-side shocks, COVID, Ukraine and Eskom, had a negative impact on recent performance. This chart shows the performance of our segregated quality offering that was launched in August 2019, not long before the outbreak of COVID, the first of the 3 in a row shocks. Our quality product underperformed its Capswix benchmark over most of this period. However, when compared to the S&P Quality SA Index, that follows a similar approach, our offering performed well given the hand dealt. The Momentum Core Equity Unit Trust invests in a blend of the single-style smart beta funds described earlier, as well as in a tracker component. This enables it to benefit from 2 powerful concepts, focus and diversification. While investors in this fund participate in the pleasing returns that the focused, trending, value and quality offerings are likely to deliver, they also enjoy a much smoother ride, as different styles typically peak and trough at different times in the cycle. The inclusion of the tracker component introduces an additional level of risk reduction. We are happy to share that this fund, despite the recent market turbulence, also delivered pleasing performance since inception back in April 2017. While risk can materially be reduced via style diversification, some residual risk always remains. This is because there are times when different factors contract simultaneously. S&P data on South Africa factor indices show that this was exactly what happened due to the recent 3 in a row supply-side shocks. Fortunately, based on history from December 2007, these converging periods has a low statistical probability of happening, as it occurred only 8% of the time since December 2007. This chart shows how a fund that invests in an equal-weighted blend of tracker, trending, value and quality components would have performed relative to its benchmark over time. While it is human to put more emphasis on recent data, it makes a lot of sense to take a step back and consider how things played out over a longer history. While this strategy performed well over the full observation period, the cyclical behavior that was present when the single styles were discussed is still at play, albeit at a much reduced level. We showed earlier how single factor funds may have lagged by more than 10% per annum during periods of extreme turbulence. In comparison, this strategy, thanks to being better diversified and thanks to the inclusion of the tracker component, is unlikely to lag its benchmark by more than 5% per annum over a rolling year. While periods of underperformance typically coincided with periods of high market uncertainty, they were usually followed by periods of strong outperformance. Over the medium term, short-term pain gets overshadowed by longer-term gains. A case in point is the performance of the Momentum Core Equity Fund showed earlier. It delivered exceptional performance since inception, despite having to navigate the recent turbulent waters. Let us zoom in on each of the periods of underperformance shown in the previous slide. This chart shows how the blended strategy reacted over the 12 months immediately following a 12-month period of underperformance. While the average outperformance over the total observation period was 3.5% per annum, the outperformance after a crisis was much higher, at 5.3%. The only period when subsequent performance was below that of the long-term average was in the aftermath of the COVID crisis. However, what was different this time around was that there were 3 consecutive supply-side shocks which did not allow for a recovery yet. Furthermore, over this lengthy observation period from December 2006 till June 2023, there were 5 periods of underperformance, and investors enjoyed material outperformance directly after 4 of these 5 periods. In other words, a hit ratio of 80%. Let us conclude our discussion revisiting 5 key observations. Firstly, smart beta investing is one of the biggest trends in equity investments right now. Please do not miss out on this. Secondly, while individual factors tend to perform well over a cycle, lagging within cycles is normal. Stay invested and enjoy the recovery. Thirdly, by blending different factors, one can enjoy a much smoother ride. Diversification is the only free lunch. Fourthly, supply-side shocks may cause factors to converge. Even well-diversified funds may temporarily underperform. However, despite recent periods of turbulence, the Momentum Core Equity Unit Trust performed exceptionally well since inception. And finally, it is clear that there is more upside from a cyclical bottom than from a cyclical top.
Thanks, Lofty. Mike Atzals will summarize and close the webinar. Thank you for joining us today. You have the floor, Mike.
Thank you for joining us today at today's Guru session, where we focus on disruption and opportunity in a rising interest rate environment. It's been a great session for us to put together, and all the speakers really enjoyed the inputs that they've been able to give you, our investors, in the Guru session. So just to recap, what did we cover today? Well, firstly, once we had got through the preliminaries, Sanisha took us through a presentation entitled Have the Low-Hanging Fruit Rotted in South Africa? And essentially she unpacked what is the current state of the South African economy, what is the role of the private sector, and what are the milestones we need to look out for South Africa to really unlock its potential. So definitely challenges ahead for the economy, but we cannot throw the baby out with the bathwater. That was Sanisha's session. She was followed by Herman, who spoke about the importance of the 2 R's in portfolio positioning, the prospect and reality of a US recession, and the implications of higher interest rates on the back of stickier and higher inflation around the world. That has implications for the investability of different asset classes. And the key takeout from his presentation was, yes, there's risk in the system, caution is warranted, but not unduly so. Afterwards, myself and Colin Graham from Robeco took a global perspective of risk and opportunity, looking from the global perspective, and really what we had an opportunity to unpack was the implication of higher interest rates on the investability of asset classes and how they need to be monitored and viewed in a global context, and what are the arising investment opportunity sets and what to be on the lookout for. Afterwards, we started to get into some portfolio particulars, and we started with Karabo, who unpacked the corporate investment opportunity set in the credit market. So as much as South Africa as a sovereign has difficulties on the debt side, corporate SA has been able to navigate the environment, and there's good investment opportunities in the unlisted and listed credit space. And finally, we finished off with Lofty Botha, who spoke about the fact that there are times when you disaggregate an index into different factors, that factors converge. Ultimately, in the long term, you can try and harvest returns from an equity portfolio by having a style allocation, but from time to time, there is convergence of the factors, and that's what's recently happened in his portfolio, but it's a short-term phenomena, not a long-term phenomena. So thank you once again for joining us today in our session, and we really look forward to seeing you again in future installments of the Gurus event.